Welcome to The Explainer. So today, we're digging into the story the market is telling itself. It's a story of, well, incredible confidence. But what if that confidence is built on a pretty fragile foundation?
I mean, just look at this question. This is how the source material kicks things off. And wow, it really sets the stage, doesn't it? It's like we're about to go on a journey, from that cozy, reassuring story we hear all the time, to the really unsettling questions hiding just underneath.
So first things first, let's really look at this confident, super optimistic narrative that's driving the markets. The analysis we're looking at calls it the alluring story, or my personal favorite, the big money show. And yeah, it's a performance we've all seen before.
And what's so interesting here is that this isn't just about spreadsheets and data points. The analysis calls it a ritual. You know exactly what they mean, right? You can picture it, the polished table, the same experts, all talking in that calm, reassuring tone that makes everything they say, it just feels inevitable, like a fact, not just some possibility.
And hey, this is the story they're selling. And you got to admit, it's pretty compelling. I mean, look at these numbers. 11% market gains, the S&P hitting 8,000. It's all supposedly powered by these huge, unstoppable forces like AI with, a nice little boost from falling interest rates and tax cuts. The way they tell it, the economy is basically this perfect machine that's already been fixed.
Okay, but now let's start looking for the cracks in that perfect foundation. It's time to peel back that first layer and really question the assumptions this whole story is built on.
And this really gets to the heart of the problem, doesn't it? It's not that being optimistic is a bad thing. Of course not. But when you hear the same story over and over and nothing bad happens, well, that can create a kind of blindness. Your own experience can actually become a trap.
So here's the kicker. For that amazing bull case we just saw to actually happen, every single one of these things has to go perfectly at the same time. These are not small ifs, They're massive assumptions. The market is basically priced for absolute perfection, as if we're somehow guaranteed to get all of the upside with, well, none of the downside.
And this brings us to the main engine of all this optimism, AI. This slide lays it out perfectly. The market is laser-focused on everything in that left column, the explosive productivity, the incredible growth. But what the analysis argues is that it's completely ignoring the right column, the price, the massive social disruption and job displacement that comes with it.
And this is such a key question. Think about it. The market has already priced in all the amazing long-term benefits of AI, but it seems to have totally forgotten about the short-term pain that has to happen first, the social friction. Because, let's be real, job displacement can happen almost overnight. Retraining people and creating new jobs, that takes years.
And this is where the argument gets really specific and frankly pretty compelling. The happy story we're told is that, oh, don't worry, the baby boomers are retiring, so that'll free up jobs. But the reality, a lot of them simply can't afford to retire. So you don't get this neat demographic solution. Instead, you get a bottleneck. You have older, experienced workers competing with AI for fewer and fewer roles. That creates a ton of social heat that the official market story just completely glosses over.
All right, so this all leads us to our next big idea, the price of perfection. Let's look at how all these different threads weave together to create a system that basically needs a flawless performance with absolutely zero room for error.
Okay, this is a really crucial point from the analysis. The idea that the market can just, naturally correct itself and find a balance. The argument here is that we're past that point. The forces at play are just too big, and the stakes are way too high for that.
So if it's not self-balancing anymore, then what is it? Well, it's managed. The whole thing now relies on constant active intervention from central banks and governments just to keep up this appearance of stability.
And this is what that management actually looks like. The term used is structural support. What does that mean? It means the Fed isn't just stepping in to stimulate the economy here and there anymore. No, it's become a permanent buyer of government debt, basically to soak up the massive supply and keep interest rates artificially low. This isn't a temporary patch. It's now a fundamental piece of the entire structure.
And this kind of dependency creates a super delicate situation. It's like a complex stage performance. For the whole optimistic story to work, it needs every single one of these things to happen perfectly. Rates have to fall right on cue. Growth has to show up right on time. AI has to deliver. Every single actor, from the Fed to the bond market, has to hit their mark flawlessly.
And that's really the heart of it.
A truly resilient system can take a punch. It can handle surprises. But this is described as choreography. And what happens to a choreographed dance when one person misses a step? The whole thing can fall apart. The market, in this view, simply can't not tolerate a surprise anymore, and that makes it incredibly brittle.
Which brings us to the final, and maybe most important warning from this whole analysis. The point isn't to try and predict a crash. It's to understand the danger of this extreme confidence itself.
Because the real danger here isn't ignorance, it's arrogance. It's that feeling of believing all the risks are understood and totally managed. When really smart people convince themselves they have everything under control, that they've literally modeled every possible outcome, that's when they stop preparing for the things they can't imagine. And that is always when the real trouble begins.
This slide just nails the core warning. On one side, you have the belief that just because we're aware of a risk, we somehow have control over it. But the reality? The system has just lost its ability to tolerate any surprises. The other belief is that the narrative is just too strong to fail. But the reality is that when a trade gets this crowded and starts to unwind, it doesn't wait for permission. The exit door is a lot smaller than people think.
And that leaves us with, one of the most classic warnings in all of finance. It's not "this will fail" that should scare you. It's "this time it's different." Because that belief, the idea that some new technology or new policy has completely changed the rules of the game, that belief is always, always at its loudest right before reality shows up to remind everyone that the rules never really changed at all.